Hey everyone, SoFi reported quarterly financial results that were a bit of a mixed bag. There were some positives and some negatives from the quarterly report, which I will identify for you in this video. I'll also update my buy recommendation in SoFi stock. Remember, I've had SoFi stock rated as a buy for several months now, and I'll update that recommendation after this video, highlighting what I digest from the quarterly earnings results, comparing it with the valuation again, and determining if it makes sense for long-term investors to buy at current prices. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. SoFi's management team noting that their financial services and tech platform segments now make up 45% of SoFi's adjusted net revenue, up from 38% a year ago and 32% 2 years ago. So the company is making excellent progress in becoming a tech platform and financial services and away from being a bank. This is a similar story if you've watched my videos on Tesla and if you've followed Tesla. Tesla's CEO Elon Musk has been trying to convince investors to treat Tesla as a tech company and not treat Tesla as a car company, because car company valuations are very, very low. Forward price to earnings ratio for car companies are in the mid single digits, but Tesla's trading at a forward price to earnings ratio of over 60. Tesla wants that, right? They want to be known as an AI company, but most of Tesla's revenue right now, over 75% of its revenue, is coming from car sales, right? But that's not happening with SoFi. SoFi is actually increasing the percentage revenue coming from the non-bank segment. So it's actually delivering growth in tech platform and financial services, right? And you see that trend here. 45% in the latest quarter. That was up from 38% a year ago and 32% 2 years ago. So you're seeing that development of the non-bank business, which attracts a higher valuation for SoFi stock. Banks, just like car companies, don't trade at premium valuations. Tech companies and financial services companies do trade at premium valuations. So SoFi is trying to become more of that tech platform, more of that financial services type revenue business, and less of bank revenue. Still, despite the rate environment and their conservative stance in lending, they drove sustained strong results in the quarter, and they're ready to move as things improve for the lending business. Remember 2 quarters ago when SoFi made their forecast for the year in 2024, and I made a video about that, and I highlighted that SoFi's management is expecting year-over-year decreases in lending revenue. And I thought that was a conservative outlook, and I thought that was prudent because coming into the year, there was increasing fears of a recession because of the higher interest rates. But fast forward to today, and the economy has performed much better than expected given the higher interest rates. Fears of a recession have all but faded away, and the Federal Reserve is now getting ready to cut interest rates, perhaps in their meeting in September. So it looks like SoFi has avoided that disaster scenario, and now management is taking a less cautious stance. And that was some of the good news for SoFi in this update. Total revenue, meanwhile, increased by 20% to $598 million, while net income delivered another positive quarter of profitability on the bottom line, $17.4 million, up from a loss of $47.5 million. Now, SoFi has only been profitable on the bottom line for just a few quarters, and it's good to see them continue this trend and continue to see that it wasn't just a one-off thing where they delivered profitability on the bottom line, that they're now consistently delivering profits on the bottom line. So one of SoFi's success recently has been the new member additions, and they continued that trend. 643,000 new additions in the quarter, and now they have total members of 8.8 million. That's up over 2.5 million or 41% from the same quarter last year. SoFi is attracting customers because of their favorable customer value proposition. They offer you a very high interest rate on your deposits, on your savings if you use direct deposit. They offer you a sign-up bonus if you switch from your bank to SoFi and you sign up with direct deposit. And so that's getting people to switch over to SoFi because their brick and mortar banks, like maybe Bank of America or JP Morgan or Wells Fargo, are becoming less useful. People are visiting in branch less often. And when you do visit in branch, there isn't very much help to be offered, right? I don't know if this is true with your banks, but the last few times I've visited my branch in person, the offices where they have people that are supposed to help you, merchant bankers, etc., they're empty. They don't have staff there. Even mortgage lenders, they don't have staff available on location. If you call in, maybe they can connect you to someone, but they don't have a person there. And so that defeats the person, defeats the reason, the strategy for even having a physical location. Why have a physical branch location when you're not going to properly staff these locations to help customers? And so that's just an advantage for SoFi. That's all digital. They don't have to pay for physical branches, and they use that money instead to offer better value for customers, that they appreciate more than just having a branch. Those branches are less important now with so much banking happening digitally. So personal loan originations of 4.2 in the second quarter were up 12% year over year. I noted earlier that management was not expecting this for this year. Overall, if you look at total originations year over year, it increased by 22% to 5.345 billion, up from 4.379 billion in the same quarter the prior year. What I was most pleased with from SoFi is growth in the other segments other than personal loans. I've been talking a lot about SoFi in how their business is too heavily concentrated in personal loans, as you can see here. And I would like to see growth from student loan and home loan categories at a much faster rate than personal loans. And I did see that here in the recent quarter. 86% growth in their student loan segment and 71% growth in their home loan segment. These are important because these are lower risk loans. Personal loans are higher risk. Of course, they offer a higher rate of interest for SoFi, but they also come with a higher risk of default. I mentioned at the top of the video that SoFi was fortunate to dodge a recession here in 2024. So far, in the event of a recession, when people lose their jobs and their incomes are decreasing, the first loan that they stop paying is personal loans. They're not going to stop paying their home loans before they stop paying their personal loans. And so the default rates on personal loans are many times higher than the default rates on home loans. It's a riskier business. It comes with higher rates of return, but I don't know if it's worth the extra risk you're taking. And so I like to see SoFi diversifying away here, getting significant growth in these other segments, and hopefully this trend continues. All right, so on to the guidance and outlook, which contained one element of bad news, but for the most part, it was good news in terms of the outlook for 2024. Let me break it down for you. So they're now updating their 2024 revenue guidance to a range of 2.425 and 2.465 billion. That's 35 million higher than they previously expected. So now they're expecting 18% growth at the midpoint versus 16% previously. So much better revenue growth expected from SoFi in 2024, given the strength they've seen so far. Now, this guidance also assumes lending revenue will be at least 95% of 2023 levels versus their prior guidance of 92 to 95% of 2023 levels. Remember, I talked about that guidance where they were saying they expect revenue to decline year over year. Now, they still expect revenue to decline by 5%, but they expect it to be a decrease of 5% or better, versus previously where they thought it was going to be a decrease of between 5 and 8%. Now they think it could be decreasing 5% at the worst, right? So that's the worst case scenario if revenue decreases 5% year over year in lending. And I think for that to happen, the rest of the year has to play out poorly. If the macroeconomic conditions continue improving as they have, I think SoFi's lending revenue will be flat or even increase, not decrease by 5%. So this is still a conservative outlook from SoFi in terms of lending revenue, but it's an improvement from previously forecasted. Now, they also expect their GAAP net income to be better at a midpoint of 180 million. That's up from a midpoint of 170 million. So that's also improved. And they expect to add at least 2.3 million members in 2024, which would represent roughly 30% growth year over year. So the only area of disappointment from their outlook was in the tech platform. So they now expect tech platform revenue to grow mid to high teens percentage year over year versus their previous guidance of 20% growth. So mid to high teens would be 15, 16, 17, 18% year over year growth in the tech platform versus 20% previously forecasted. So less of the business is going to be consisted of tech, and more of the business is going to be lending, which is the bank side of the business. And as I highlighted at the beginning of the video, SoFi wants to be considered more of a tech and financial services business. And this guidance is kind of the opposite of that slightly, right? Revenue growing much better than expected in lending, and revenue growing a little less than expected in tech. Still, overall, tech will be a larger percentage because it's growing at mid to high teens, where lending is going to be flat-ish, right? So still positive, but the delta from the previous quarter to the current quarter in the outlook was slightly negative. That's mainly the only bad thing I saw from the outlook for 2024. Now, I've had SoFi stock rated as a buy, and I last updated that recommendation on June 18th. And following these earnings results and looking at the company's valuation, is trading at a forward PE of 34. And given their positive earnings prospects and the long run tailwind, I still think the stock is a buy, and I'm reiterating that buy recommendation today. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.